Good afternoon. My name is Kim Schoenholtz. I'm delighted to welcome you to the Spring 2019 NYU Stern Economic and Market Outlook Forum. The host of today's program is the Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. We're especially pleased today to have here students and faculty from all over NYU, as well as a number of Stern alums. Thank you very much for joining us. Today's program will last about 85 minutes. It will begin with presentations of 5 to 10 minutes by each of the panelists, followed by audience Q&A. We'll finish by 6:30 p.m. Please note on the screen that you can submit questions to the panel using your smartphone by going to the website www.slido.com, S-L-I-D-O, and entering the code number 6666 in the box labeled Join. Anonymous questions will not be accepted, so you must provide your full name. You can also vote on the questions that others have submitted. Your votes will help us judge the issues that are of greatest interest to the audience as a whole. Let me now introduce our distinguished panelists. Jan Hatzius, to my left, is the chief economist and head of global economics and markets research at Goldman Sachs. For 6 years, Jan has been the #1 ranked economist in the annual Institutional Investor All-America Fixed Income Research Team. He serves on the economic advisory panels of the Federal Reserve Bank of New York and the Congressional Budget Office. Dr. Hatzius received his PhD in economics from Oxford University. Catherine Mann, to his left, actually from your perspective, to his right, joined Citigroup as chief global economist almost exactly 1 year ago. Previously, she was chief economist of the OECD, where she also worked closely with the G7 and G20. Earlier in her career, Kathy worked at the Federal Reserve Board, the Council of Economic Advisors, and the World Bank, and engaged in research and teaching at the Peterson Institute and as the Rosenberg Professor of Global Finance at Brandeis University. Dr. Mann received her PhD in economics at MIT. Stephen Roach is a senior fellow at Yale University's Jackson Institute of Global Affairs and a senior lecturer at Yale's School of Management. Formerly, he was chairman of Morgan Stanley Asia, and for the bulk of his 30-year career at Morgan Stanley, the firm's chief economist and head of its global economics research team. Earlier in his career, Steve served on the research staff of the Federal Reserve Board. Professor Roach received his PhD in economics here at NYU. You're supposed to cheer now. That's the... Okay, we're getting you trained. Please join me. Please join me in welcoming our distinguished panelists. Following alphabetic order, Jan will now begin the presentations, followed by Kathy and Steve. After their brief initial remarks, we'll begin the Q&A session.
All right, great. Thank you, Kim, for that introduction and for the invitation. It's wonderful to be back here in this panel. Look forward to the discussion. I already saw a lot of great questions that were submitted earlier, but that's I think probably the main point of this. So I'll keep it very brief on our expectations for the U.S. and the global economy. Generally, after a couple of years of generally strong growth globally, close to 4%. We are looking at softer growth in a number of places, not all kind of slowing at the same time or to the same degree, but clearly things have generally softened. And if I put myself back and focus on the U.S., put myself back in the situation of September, October, our expectation at that point was gradual deceleration from far above trend growth in the middle of 2018, 3.5% or so, maybe even a little bit more, to something basically trend-like, which I would put at maybe 175 by the late part of 2019. We thought gradual deceleration in an environment in which the Fed would gradually continue hiking the funds rate roughly once a quarter, and that would gradually tighten financial conditions and bring the economy down to a trend pace where it needs to get to probably sooner rather than later, given that the labor market's already quite tight and and inflation is basically at the Fed's target. Things have changed a bit in recent months, as you may have noticed. I think now the outlook is probably a little bit more less now, but maybe a little bit more later, for a few different reasons. Number one, there are some, I think, seasonal adjustment distortions in the US GDP numbers. There's a long-standing tendency, not yet corrected, for first quarter GDP growth to be below the average of the remaining 3 quarters of the year. That's a very short-term effect, but that may weigh on Q1 once again this year. Second, of course, there was a government shutdown, longest government shutdown on record, partial government shutdown. That government shutdown is going to weigh on first quarter GDP growth. It also has weighed on sentiment. Certainly many of the surveys among businesses and households have been significantly weaker over the last couple of months. That's also a temporary effect that's probably going to come back. And then finally, financial conditions tightened very sharply, of course, in the fourth quarter. Our financial conditions index tightened sharply to tightest levels since basically early 2016. And that's going to weigh on growth, probably already has weighed on growth to some degree in the short term, but probably also a temporary effect, especially given the fact that much of the market swoon in the equity and credit markets that you saw in Q4 has already unwound. So all of that means less now, maybe a little bit more later. And so we actually, we've generally been cutting our early 2019 numbers, but have actually raised a little bit the back half numbers. We're now looking for about 2% growth in the U.S. over the 4 quarters of 2019. Less than that, we're currently 1.7% for Q1. We think there's going to be a rebound in Q2, 2.25% to 2.5%, and then about 2% growth. Now, this does assume, this upward revision, especially to the back half, does assume that the Federal Reserve basically ratifies the easing in financial conditions that has occurred over the last several weeks. And I think that's consistent with the message we heard from Chairman Powell a week ago, where he indicated basically no bias for future rate hikes, at least for the time being. Patience, almost all members of the FOMC have repeated that message, and so I think there's a pretty strong guidance now that rate hikes are unlikely for at least a number of months. Our view is that a March rate hike is off the table. A June rate hike, I think, is relatively unlikely. Still a possibility, but we think relatively unlikely, maybe 1 in 4. And beyond that, it's really going to depend on how the economy does. Now, our view is that we'll probably still get a rate hike in the second half of the year. There may be additional hikes, again, depending on the economy. But we still do think that the rate hike cycle is not behind us, basically because 2%, while it's not a great pace of growth, it's probably still consistent with improvement in the labor market from a level that's already quite tight. We don't think we're going to continue to print let alone 300,000 payroll numbers, but we still think that we're going to be above the kind of pace that's needed to keep the unemployment rate stable. And we also think that inflation is more likely to drift somewhat higher. The wage numbers have continued to look pretty encouraging. We're now above 3% for nominal wage growth, and we think ultimately late in the year that's also going to translate into core inflation probably being a little bit above 2%. So our view is one more hike this year. Bond market is pricing cuts, not really in 2019, but in 2020. While we have definitely adjusted our Fed expectations pretty sharply, we had 4 hikes several months ago. We now have 1 hike. We're still north of what the bond market's pricing, and I think the main reason for that is that we put a lower risk on recession in the near term than probably many market participants do. Our view is basically that the U.S. economy has become less recession prone. We do buy into the idea of the great moderation literature that started in the 1990s, that the economy has become less cyclical, partly because it's become a service economy and things like the inventory cycle are no longer as important. We think that the economy is less vulnerable to oil shocks, which were a major driver of recessions in the past, and especially in the 70s and 80s, of course. And we think that inflation is much more anchored than it was. That's very important. Inflation expectations are very anchored. When inflation expectations are unanchored and the labor market overheats, the Fed needs to react to that aggressively and quickly in order to prevent spiraling inflation. When inflation expectations are anchored, the Fed still needs to react to labor market overheating, but has somewhat more time and can be more gradual about the response. So I think all these things make the economy more stable. Now, of course, despite the great moderation, we've still had recessions, including, of course, a very deep one. And the reason for that is that, while real economic imbalances definitely look smaller than they did, financial imbalances are really what has pushed us into a recession twice in the last couple of decades. And so that's definitely something to watch. However, I think at the moment, the risk of significant financial imbalances, to me, looks fairly limited. I don't see a bubble in the various asset markets. Broadly speaking, we can talk about details, but broadly speaking, I don't see a valuation problem. And more importantly, the private sector of the economy is not living beyond its means the way it did prior to the 2008 downturn, the 2001 downturn, and financially driven downturns in many developed economies around the world for the last 30 years. And what I'm specifically focused on in that regard is the private sector financial balance, the difference between the total income and total spending of all households and businesses. I think it's a great warning sign of a private sector spending that is vulnerable to an asset price downturn. When the private sector spends more than it earns, then basically by definition, it's relying on credit on credit growth to keep its spending at that level. When credit growth slows, credit availability dries up, financial market conditions deteriorate, you need to see a sharp pullback. That was the situation of 2000, the situation of 2006, 2007, with private sector deficits of 3 to 5% of GDP. Now it's reassuring that the private sector is running a financial surplus of 4% of GDP looks much less vulnerable. So that's sort of my view on the known unknowns as far as recession risk is concerned. Of course, there are unknown unknowns, and some of them revolving around greater global linkages, some of them revolving around fiscal policy and political dysfunction and risk of things like debt ceiling events. So you should never be too confident in a forecast that we're not going to be in recession. But I would say I'm on the glass half full side of that debate, which is one reason why I think markets are too low in terms of pricing future interest rates. I don't know if I'm.
One more minute.
If I have one more minute, let me spend 1 minute on non-U.S. issues. I'd say generally the news in the U.S. has been stronger than outside the U.S. in 2018. Most other places have slowed or slowed sharply. It's very difficult to think of exceptions to that. I think there are kind of two groups of countries in that regard. Basically, countries that slowed very sharply in 2018, in many cases around the middle of 2018, EM economies outside of China that in some cases went into crisis-like conditions and deep recessions. In most of these places, at least on average, things look a little bit more stable, definitely more stable in terms of financial conditions, and a bit better as far as real economic indicators are concerned. Our high-frequency measures of economic activity have generally picked up there, obviously not everywhere. But I think there, some improvement is not only a forecast, but already a fact that we can see in the data. And then there are economies that have continued to slow. I would say that's very much true for China, and it's very much true for the euro area, where even the latest run of data still looks weaker. We're expecting some stabilization there, maybe some improvement in the second half of the year. I think there are some good reasons for things to get a bit better in China, revolving mainly around the authorities' desire to stabilize growth, not too far from 6%, and therefore macroeconomic easing. In the euro area, revolving around factors like lower oil prices, which help Europe more than other places that produce more oil domestically. Some fiscal boost, unlike in the U.S. where the fiscal boost is diminishing. In Europe, it's growing a bit. And number three, better wage growth, which has been a fairly sizable shift in the European data after a long period of extremely weak wage and private sector income growth. We're starting to see some lift, so I'm hopeful that we'll see some pickup in the sequential numbers. Thanks.
Thank you, Jan. Kathy?
So it's really great to be back in the classroom. I enjoyed my time teaching at Brandeis very much, and I always am looking forward to an opportunity to speak to students again, and I'm very much looking forward to your questions. So in terms of the contours of the numbers that Jan put out for the global economy, for the US economy, I'm not so different, but I do have a different way of describing the pattern of data that we look at in order to derive our prospects for 19 and into 20. Rather than sort of take the macroeconomic aggregate GDP, I think it is very useful to make a distinction between the strength of economies with regard to their domestic, what I call their domestic resilience, think of it as consumption and investment, and contrast that with weakness or headwinds in the external sector. Those two are balanced against each other in most economies, and how those two play out, the balance plays out, is more domestic resilience or more external vulnerability This is an important first ingredient in thinking about prospects for individual economies, but also for the global economy in 2019 and into 2020. How we would judge that strength, I think it's very important to evaluate the strength in two dimensions. One, the deltas that we see in data, and I'll be more explicit in a minute, versus the levels. And there is a preponderance and focus on the deltas, the change in data, and as opposed to the level or the growth rate. Now there's a third pillar to our prospects for 2019, and that is financial turbulence, and specifically the feedback effects of financial turbulence into the real economy through the channels directly from financial conditions, but also indirectly through sentiment. And so when we try to evaluate these three pillars against each other to determine where we are going to be in terms of US growth, China growth, European growth, and emerging markets, it's important, as I say, to go back to seeing where we are with the deltas versus the levels. So let me be a little bit more explicit here. So let's first talk about domestic resilience. How strong are domestic economies when we look around the world? You know, the US, historically low unemployment rate, rising wages, bringing people back into the labor force participation rate rising. Europe, we think of Europe as kind of slow, but actually, Europe has very strong wages, as Jan pointed out. It also has increasing labor force participation across all groups, and historically low unemployment rates when you think about Europe as a whole. So very strong foundations for domestic resilience. In addition, in a lot of these markets, including the US and including a number of the Nordic countries within Europe, as well as Japan and Germany, very tight labor markets means there's labor market shortages. So not only is there strength in terms of domestic resilience when we think about the foundations for consumption, but it is also the case that labor market shortages create the conditions by which firms have to invest either to complement the workers that they can hire, some cases kind of the bottom of the barrel, none of you, of course, but on other cases to substitute for labor that they can't hire. So the labor market tightness, as I say, has this foundation for both consumption strength, but also investment strength. Now you'll have people tell you, oh, well, investment actually is slowing down. But this is where deltas versus levels matters. If you look at machinery and equipment investment, for example, or you look at trade in technology products, the growth rates are quite strong, 2 or 3 times in terms of machinery and equipment relative to a long-term average. So yes, there will be some slowing of investment growth rates from 18 into 2018 into 2020, but the rate of growth is more than two times what it has been in historical terms. So that is strong investment, it's just somewhat slowing. Another sort of metric of domestic resilience that we like to think about are the PMIs, the Purchasing Managers Index and Institute for Supply Management Index. Now, many people looked at the December data for the PMI in manufacturing and they said, wow, it dropped 4 index points. Ooh, recession on the horizon. But it dropped from 58 to 54. Anything above 50 is in expansion territory. And if we think about it in the past, we would have said 54, this is fabulous. It's just that it came down from 58. And so people focused on the negative deltas as opposed to the positive expansion strength. In advanced economies, where services are the principal thing that we consume, it matters what happens to the non-manufacturing PMIs, and those continue to be very strong, 57 or above, for advanced economies as well as for emerging markets. So again, by thinking about the deltas versus the levels, on domestic resilience, you get a picture of a very strong condition in most economies. Not China. China is different. China has been slowing since a year ago. Originally, China was slowing on account of their policy effort to rein in domestic financial excess. Got a little out of hand, and it had collateral damage to the household sector. First, because real estate prices turned over, that's a wealth shock, and second, because credit availability to private-owned enterprises was restricted relatively more than to state-owned enterprises, and when the private-owned enterprises had to deal with this credit problem, they tended to fire their workers, something that is not normally done. And so your consumers in China were facing both a situation of wealth shock and employment insecurity, so not surprisingly, household consumption started to slow as well. Not go negative, of course, but to slow. Then you add on top of that the trade headwinds. And that is, we've got C, I, X, and M all in negative terrain, so there's not a lot of support in the economy other than through the efforts being put forward by the policies that China has been putting into place. They've kind of pulled a lot of rabbits out of the hat. We don't know exactly how well they're going to work, but they'll probably be at least able to arrest the deterioration in growth rates. So domestic resilience strong, except for in China. Let's talk a little bit more about the trade headwinds, because they are very significant. They are escalating. There may be an agreement on the horizon. We think that there will be trade limbo for an extended period of time. There may well be a veneer agreement. We call it that because it addresses just the bilateral balance problem between China and the US. So it's a veneer, buying more oil, ag, autos, and will not solve any of the long-term structural problems, which have been part of the terrain for quite a while. And the threat of tariffs, the 25% of the 200 billion plus maybe 25% on everything, that will be on the table, or sort of like the sword of Damocles, over the trade situation for quite some time. Now, the implications of the trade tensions that we have to date, they percolate through the global economy in a very heterogeneous manner. Countries that are part of the supply chain, the China supply chain, are vulnerable to that shock of the US potentially putting 25% tariffs. And in fact, many firms have already moved or are in the process of moving their supply chains out of China. Maybe they were thinking about doing it anyway. 25% threat is going to kick you to change that production location. You're going to move now. Why not? And that is rearranging some of these supply networks already. As I say, they have differential impacts on economies. Our first three that are most vulnerable are Taiwan, Singapore, and Korea. The second three are Malaysia, Thailand, and Vietnam. But of course, if I'm a US buyer and I'm not going to buy from China anymore, I'm going to go search for another source of supply. The US administration would like that supply to be in the United States, but that's not going to happen. So, because the price differentials are significant enough. So we look at trade diversion as a second round effect for how these trade headwinds percolate through the global economy. And we find that in terms of trade diversion, if I'm a US buyer and I'm not going to buy from China, who am I going to buy from instead? It is the first I will turn to is Canada and Mexico. After that, Malaysia, Vietnam, and Thailand. So they lose initially on the shock, but they gain back, not 100%. There are net losers here in the global economy to this trade headwinds. But a country like Korea, which is in the first tier of vulnerability, they are not in the first or second or even third or fourth tier of an economy that a US buyer will go to in looking for their second buyer, second source of supply. So let's turn now to the third pillar, which is financial conditions and financial turbulence. We have to start by recognizing that 10 years of quantitative easing have created a constellation of asset prices, equity prices, credit premia, the 10-year yield, the whole yield curve of the US Treasury, the exchange value of the dollar. This constellation of asset prices is being jostled by the progress towards monetary policy normalization by the Federal Reserve. By being jostled, what we mean is that equity markets kind of, are a little turbulent. You see the VIX go up every once in a while. There's this concern about collateralized loan obligations. There's this issue about, how much should companies that have credit-light conditions be paying for the riskiness that they present. So again, looking at this constellation of asset prices and thinking about what the Federal Reserve is doing with regard to monetary policy normalization, we are going to expect financial turbulence. It's part of taking the punch bowl away, is you're going to have financial market turbulence. So when I see what's going on in the financial markets, again, I look at financial condition indicators. Yes, they tightened in December. That was an end-of-year effect more than anything else. But they were still in accommodative territory. Credit, if we look at credit conditions, just credit flow, plenty of credit around the world, in the UK, Europe, Japan, in the US as well. So financial conditions, even though there's some turbulence, are still very definitely in accommodative territory. Again, thinking about the deltas versus the levels. Now, what do we have to do in order to complete our exit from quantitative easing? Because that's ultimately the goal of Federal Reserve has to do that. Or we'd like to have them do that, preferably before the next recession starts. And the first ingredient of that is to have these constellation of asset prices realign, probably associated with a higher 10-year yield, a higher credit premium or risk premium than we see right now on high-risk debt, probably a situation where equity markets are correcting, maybe a little bit more than they have corrected so far because they are still well above a long-term average of Shiller cyclically adjusted PE ratios. And so that constellation, we are not there yet. We've made some progress to achieve it, but we're not there yet, so there's going to be more financial market turbulence. The second thing that has to happen for completion of exiting from quantitative easing is a durable 2% inflation. If you look at financial market pricing of inflation expectations, the anchor that Jan mentioned, it's not at 2, it's below 2. Financial markets do not believe that the Federal Reserve is going to achieve a durable 2% inflation. So the Fed has to wait longer to increase the next step of the potential move in policy in order to allow an inflation surprise to jostle the markets and get them to realign their inflation premium and the term premium. So they want to do two things. They have to increase the policy rate to jostle. They also have to delay that move in order to let inflation come through. It's a very big balancing act for the two of them. The real issue in the end, and finishing up, is does this financial market turbulence cause businesses' sentiment and therefore their decisions to invest? Does it cause them to pause, particularly in an environment where the trade headwinds are pretty strong, even though the domestic resilience is very strong as well? If business investment chooses to pause because of financial market turbulence, that could be a self-fulfilling recession. And so we look very carefully at the relationship between business sentiment, business orders, and business outlays to try to evaluate whether or not we are at the stage where business is starting to delay or pause their investment. And this is something we can look at in the US and in other countries around the world.
Great. Thank you, Kathy. Steve?
Thank you, Kim. It's a pleasure to be here. I'm so old that when I was here, this building didn't exist. But I had a great career on Wall Street, which is an endorsement for those of you who think you can't make it from NYU. You're wrong. I looked at the questions that Kim was kind enough to forward, and I gotta set my watch for 10 minutes, okay?
Excellent.
And I saw a lot of questions about the U.S.-China relationship, and both Jan and Kathy alluded to that to some extent. And I want to try to draw that out a little bit more, because I do think it's a major risk factor to the sort of great moderation 2.0 that Jan seemed to endorse to some extent in his comments. Before I do that, though, I just want to get a sense of the level of hostility in this room. I'm going to describe two scenarios, and I want to just get you to vote on them. Let me describe them first. The first scenario is that China has been ripping off America for a long time, and it's high time that we get back at China. The second scenario, and we're not voting yet, so I mean, you're so eager, you just can't wait to endorse it. The second scenario is that the U.S. is actually a lot more vulnerable than you might think, and we need a scapegoat, and China is a scapegoat. So how many of you are in favor of the first scenario, where it's high time to go back, to go after the cheater? Let's see it. A show of hands. Come on. Very, very few. And then you have to vote. I mean, if you don't vote, you're not going to be allowed to leave the room. The second scenario is that the U.S. is vulnerable and we need a scapegoat. How many in favor of that? Oh, wow. Maybe it's the NYU thing. Okay. That's always possible, but that's sort of a wimpy way to phrase it. I mean, it's like saying there's good news and bad news, and we don't know how it's going to play out. But that's a fair point. I have to say that I'm more supportive of what I find to be a shocking consensus in this room, that the U.S. is, China's certainly not perfect. We're not perfect, but the U.S. has made a case against China that really is difficult to substantiate, especially when you look at the evidence that's been assembled to justify the tariffs and the possible escalation of those tariffs. My own sense is that, I think Kathy described it well, if there is a deal, it'll be sort of a false deal. It will address the bilateral aspect of the imbalance, which is really more of an outgrowth of the shortfall of domestic saving in the United States that creates a lot of bilateral trade deficits that the U.S. has. The biggest one, of course, is with China. But the broader sort of called structural issues of innovation, allegations of intellectual property theft, the cyber issues, the concerns over China's seemingly unfair industrial policy, those issues are unlikely to be addressed between now and the end of this month. So if we get a deal, and I think both presidents want a deal, it'll be a weak deal, a cosmetic deal that will feature mainly a lot of buying by China and possibly an agreement on a framework to negotiate these other deals, these other issues. I will give the Trump administration credit for elevating the debate to a higher level than we've had it before in terms of the intensity by which we're focusing on these big structural issues. Having said that, I am disturbed by the way in which the issues have been presented to the broader public. The trade hawks in the Trump administration, the president himself, the U.S. Trade Representative Robert Lighthizer, and of course everybody's favorite villain in the story, the notorious Peter Navarro. They've framed this challenge in a very frightening way for the American public. To quote Mr. Navarro, China has targeted America's industries of the future. If China successfully captures these emerging industries, America will have no economic future. I mean, that's a really awful picture to paint. And if it's true, it's something that we need to take very seriously. It's very clear to me that even if you completely disagree with that statement has formed the basis for the charges that were formalized in a so-called Section 301 report, 182 pages long, that was published by the Trade Representative Lighthizer last March, which has become the basis for the tariffs that have been announced and are threatened to be escalated at the beginning of March if a deal is not struck. All I can say is, I've looked at the evidence very carefully, the 182-page report, and the supporting evidence on which it is based, namely the so-called IP Commission, chaired by two illustrious American patriots, former Director of National Intelligence Dennis Blair, former China Ambassador John Huntsman, currently Ambassador to Russia. I've looked at the evidence really carefully from those sources as well as the evidence that Lighthizer has assembled in his report, and it's not worth the paper it's printed on. It's weak evidence in virtually every count. Let me just give you one example. The poster child of the case against China is this allegation of forced technology transfer through joint ventures. And when you talk to reasonably rational people, they say this is exactly the problem with China, is they force American companies to turn over the technology against their better wishes. China has required joint ventures for about 20 years in many, many areas of cross-border investment by multinationals in their markets, although the requirements are slowly being peeled away. The allegation is not that there's a transfer. The allegation is that these transfers are forced, that companies are actually, against their better wishes, coerced into turning over their technology as a price for doing business. Lighthizer, I'll be specific, on page 19 of his 182-page report says he has no evidence of that that the forcing occurs verbally and behind closed doors. And so he brings out proxy evidence from surveys of companies who say they're uncomfortable doing business in China, conducted by the US-China Business Council. Allegation by allegation by allegation, I could take you through them, they're supported on the basis of very flimsy evidence that would not hold up in court. And so to take these types of actions against another country and to marshal the very strong political animosity that's developed, and I would say both Republican and Democrats alike, against a country like China, has colored the discourse in a way that will be very, very difficult to repair this relationship for a long, long time. So my watch is buzzing, so I will invoke the Jan Hatzius rule and take one more minute.
Which is actually 2 more minutes.
Sounds good to me. But I'll try and do it in one. Industrial policy, China does it, absolutely. I just read, I think this morning in the Wall Street Journal that the Trump administration is putting together a plan to dominate artificial intelligence and other leading technology areas. Japan's done industrial policy. Germany, through Industry 4.0, does it. There's two sides to every single one of these issues. It's unfortunate that we have elevated our complaints against China into a position where we have sparked a series of actions that could easily escalate next month if we don't come to a deal. There is a deal that could be struck that would need to address the issues of substance, and I'll just tick off what I would like to see if I could talk to these, some sense into these two leaders. One, to take the joint venture issue off the table, to open up market access on both sides of the bilateral investment equation by doing a BIT, a bilateral investment treaty, by eliminating the ownership caps that are required for cross-border investment. Number two, I'd be in favor of having both nations take the lead in forging a global cyber accord. You can't do cyber bilaterally. You have to do it globally. The idea that we need a broader global platform to do that, I think, has escaped both countries at this juncture. Number three, the structure of engagement that shapes the dialogue between our nations is ridiculous. We used to do it, twice a year under G.W. Bush, once a year under Obama, once, period, under Trump. They now prefer to do dinner parties at Mar-a-Lago and Buenos Aires and Beijing. We need a permanent organization to deal with this relationship on an ongoing basis. And fourth and finally, both countries do have serious savings imbalances. We save too little. China saves too much. And a commitment to restoring macro balance would be an important part of the agreement, would take some of these bilateral tensions out of the equation. I'll stop at that point, Kim, without even talking about Huawei.
We'll get there. Thank you, Steve. First, can we have the Slido information up? Thank you. This is now your chance to submit questions and indeed to vote on others' questions. Your votes really matter. All you have to do is go to slido.com, enter join at 6666, and start participating. This is the way we'll get you involved. In order to make a transition, I'm going to ask a question that sort of follows up on this discussion, and I have two ways to pose it, but let's ask the first way. As far as I could tell, the three of you are agreeing that the most likely outcome next month is some kind of agreement, whether it's cosmetic or maybe a little deeper than that. There must be some risk that, in fact, U.S. tariffs go up to 25%. How much is that going to affect your perceptions of the outlook for the U.S. and the global economy? I'm not sure who wants to start.
I'm willing to start with that because actually, my view is that the tariffs will go up on March 1st, that the financial markets will not like that and will move downward, and that shortly thereafter, an agreement will be reached. So that, and the reason why I think that's the likely outcome is because there's a Trump wants to use his credible threat, but he will cave in the face of the markets. And we do have an interesting note that evaluates his tweets in relationship to market differentials between the S&P and the Shanghai, and find that he's both a leading and lagging indicator. So it's hard to say exactly. It depends on whether it's a positive tweet or a negative tweet, and so forth. So tweets can play an important role, and I think that he will test that, test the threat, and the markets will respond. And shortly thereafter, there will be an agreement. Because it won't be so long, it will be yet another bout of financial market turbulence. The question will be, how many bouts of financial market turbulence can businesses handle before they decide to wait out the next 6 months?
Anybody else want to jump in?
I just have a question for Kathy.
Yeah?
You've done a detailed analysis of tweets. Do they
Yeah.
take place during executive time or outside of executive time? I mean, that's pretty important, right?
I'm not sure that the database has we did not, as far as I know, we did not use the time of the tweet. We looked at the character of the tweet. In other words, you can identify.
Did you look at the character of the tweeter?
That's a fixed effect.
Okay.
That's a fixed effect. Okay. Same guy. We presume. I mean, we don't know for sure, but.
Okay.
Jan, did you want to add something?
Well, I mean, my view is that I don't know what's going to come out. I mean, I think our rule has generally been not to get too far away from 50% when it comes to these kinds of decisions, because it's. I think it's difficult to say. I mean, what Kathy says may well happen. Our baseline is that there will be a deal, but it's not held with a great deal of confidence. I think if you didn't have a deal, you had a further escalation, it would be, I think, a negative event for China from a kind of real economic perspective. China is a surplus country, especially in relation to the U.S. So there are some Keynesian, negative demand effects if you see an increase in trade barriers. The numbers that we get out of the potential escalation, even for China, are not enormous. They're sort of in the range of a quarter point to maybe a little less than a half point. But of course, that would be coming in an environment where the Chinese economy is already pretty weak. I mean, if we look at our latest kind of high-frequency numbers on growth, basically aggregating all of the monthly numbers that are reported on the Chinese economy, we're in the kind of 5% range, or even a little bit less than that. That's not the number for the whole year, but that is the current run rate. And so, I think additional negative news out of the trade negotiations would be, very unwelcome. I think in the U.S., it really depends a lot more on the financial market reaction. Financial conditions matter quite a bit for the U.S. In terms of the short-term growth numbers, and I think you can demonstrate that pretty clearly. The direct effects of greater trade barriers on the U.S. I think are much smaller. The U.S. is a deficit country, and while the case for free trade from kind of a long-term comparative advantage perspective doesn't rest on whether a country runs a deficit or a surplus, in the short term it does matter quite a bit. And so I think in the U.S. It's really more financial condition story. If there's a big if there's a large tightening of financial conditions on the back of bad trade news, then the market can, to some degree, make its own reality, at least for a while.
Okay. I'm going to try and move to something we haven't talked about. Each of you mentioned the potential for some political disturbance, but one of the issues that's on the table is Brexit. And the question that's in the list is essentially, what are the implications for Europe, for Britain, for the rest of the world if we end up going into Brexit without a deal? Does anybody want to? Maybe that's the base case that you're assuming.
Our view is that the clock will stop at 11:59. That there will not be a crashing out of the UK from Europe. It's not in the interests of the European economies. The UK is a not insignificant trading partner for them. It's clearly not in the interests of the UK either, damaging both the domestic economy as well as putting at risk some other very important agreements that have been made within the United Kingdom. So the crashing out scenario, I mean, accidents can happen, obviously, but the crashing out scenario, the no deal scenario, is so not in the interests of either the economics or the politics that the stopping the clock is a viable option. The European Court of Justice gives them the opportunity, gives them the out to do that. That said, the private sector, the economics of this, the train left the station already. I mean, the businesses are making their decisions. The politics can stop at 11:59, but the business is still making decisions, and their decisions are to move their value chains, to move their headquarters, and that has a deleterious effect on the UK economy, and it's beneficial in different ways for different countries, are those who receive the benefits of investment.
I mean, I would say it's a big deal for the UK. It's a medium-sized deal for the EU 27, and I think it's a relatively small deal probably from the perspective of the rest of the world. I think it's difficult to have any confidence in the numbers that are out there. But if you look at some of the simulations that various organizations, including the UK Treasury, have run, you're talking several percent of GDP in the longer term from a no-deal Brexit, and 8% or so, I think is the number from the Treasury for no deal. If you have a deal along the lines of the May agreement or the end state that may be associated with the May agreement, there still will be a cost, but would be commensurately smaller. These are very important decisions for the UK. I agree with Kathy that a crashing out scenario is still more of a tail risk than anything close to the baseline. If you look at Parliament, there is a clear majority against crashing out, and I do think the most likely outcome, overwhelmingly, I think the most likely outcome is that a crashing out is going to be prevented. I think for the EU 27, it's not anywhere near as important as for the UK, which is why the negotiating position has been so unbalanced and continues to be so unbalanced. And I think from the perspective of the US, it's probably not a major factor in the economic outlook.
Steve?
Yeah, I think these two issues that you have raised, Kim, the U.S.-China issue and Brexit, you've asked us to answer them in isolation. I think we would also benefit from thinking of them together. Jan laid out a good, solid base case for the U.S. And the world economy, and a case that would be certainly constructive for financial markets. If we've learned anything over the last few decades, is that base cases work a large portion of the time, but the shocks are what end up killing us. And the combination of an escalation of the tariff war between the U.S. and China and a disorderly Brexit, I think would be a devastating blow to world financial markets and to the global economy. I think the odds of that are low but non-trivial. And we should think about these two questions, not just in isolation, but collectively.
Okay. Actually, the top question here is something that should appeal to all of you, since you've been in the business of economic forecasting. And the question is, what are the biggest challenges in economic forecasting, and what can we do to make forecasting more effective?
Well, I mean, the biggest challenge is that forecasting the short-run ups and downs of the economy is, you're forecasting human behavior and the interaction of human behavior both in the real economy and in financial markets. And it's very difficult to find scientific ways of doing that. And a lot of the models that all of us have learned in university are not particularly accurate in predicting what's going to happen, especially in the shorter term, if you're trying to predict the ups and downs of growth rates or interest rates. So I mean, I think there is a lot of useful intellectual material that can be brought to bear on economic forecasting, and I think modeling the link between, say, monetary policy, financial conditions, and growth, or the boost or drag from things like fiscal policy and or changes in commodity prices for growth, modeling the link between resource utilization in the labor market and inflation. All of these things are quite useful, and we spend an enormous amount of time on developing that infrastructure, but you've also got to be realistic to know that significant. I mean, as Steve said, that gives you a base case, and the base case works, a decent proportion of the time, but far from 100%, and often it is not. The most interesting times for economic forecasters occur when you've got significant shocks. So I don't know what makes a good forecaster. For me, I think it's sort of combining the attention to detail and the focus on the more kind of model-driven, precise parts of the economic analysis universe, and the judgment to know which model to use and how to respond to new information, and how to recognize if your model is going off track, and how to then decide what alternative view to adopt. And those I think qualities don't naturally go together. I mean, I think people who are sufficiently detail-oriented and focused on the analytics are often somewhat inflexible in changing their. They fall in love with their model and are inflexible in maybe throwing out the model and adopting a different one, or relying on other modes of analysis like historical observation, and so I think that's pretty challenging. You do need to combine both of these things, but they don't naturally go together.
The real important question is, what are you trying to forecast? Who are you serving? Who's your client? Because the type of forecasting model or even methods that you would use for a very short-term horizon financial market client is going to be very different than the approach that you might use for a long-term investor. And in some cases, for example, the financial market client, short-term financial market client, may not care at all about the level of causality. It's irrelevant. It's like they want to know the relationship. They want to know the correlation and the reason for the correlation to deliver a particular relationship. They don't care about it at all. So something that uses certain kinds of more advanced techniques that we're looking at now, machine learning or AI, might deliver a very, very good forecast in the short term. You may not know why, because you've got a gazillion variables in there, but if you don't care, you just want to know in order to make a bet, that's fine. That's fine. But that doesn't work as well the longer you go out. Where you try to focus on what are the main drivers of relationships, and so that if something, if a policy change happens, or if we have a shock of a natural disaster, or a political issue, or other shocks that we have to deal with periodically, you do want to understand how those percolate through a very complex economic system. And so you do want to know that, and that is where the kinds of model building that Jan was mentioning is more important. The critical ingredient that I think was part of the missing on the great financial crisis was the interrelationship between financial markets and the real economy. I think we are still struggling with that because modeling that relationship is not easy. First, because financial markets do often have a much different tenor than real economic variables. It's hard to put them together into a single model. They have a lot of feedback effects, not all of which we have enough data to evaluate. And so that is a critical, important ingredient right now. And as I say, it's a real challenge to do that. We have a lot more information than we used to. How to deploy it in a way that we can think through it is still a bit of a challenge. Having more data doesn't mean you understand anything better. You might, but then again, you might not. And so there, as I say, the challenges are the timetable of your client, or the time tenor of your client, how much you really care about microeconomic complexity. I mean, if you're doing something for equity investors, they want to know about firm-level analysis. A macro thing is not really going to be terribly useful for them. So you've got to get down into a lot of granularity about firms, about countries, about products and trade, for example. And so that's a different type of model, a different kind of work than if you're doing sort of GDP forecasting and inflation. Even for those, I would argue that we need a lot more granularity than we have been tended to use in the past.
I would say more data is helpful for nowcasting. So
Yeah.
I do think that's something that
Yeah.
that we actually have gotten, I think, a lot better at, figuring out what's going on in the economy right now in the very, very recent past, and just bringing more data to bear on that, I think, is helpful. But once you go beyond the very short-term horizon, it gets, I think, less charitable.
Weather forecasters are happy if they can forecast out 3 days, so
Right.
hopefully we can
Investors,
catch up.
we would like to think investors will think beyond that
Steve,
horizon.
did you want to add anything?
Yeah, look, if you choose to be a forecaster, you have to accept the fact that you're going to be wrong, sometimes a lot. The most important piece of advice I can give you is have a framework. The framework can be a model, it can be an idea, a theme, it can be qualitative, it can be quantitative. So when you are wrong, you understand why you are wrong. And be honest enough and candid enough to own up to the flaws in your thinking. And I think your clients and your peers will learn a lot from your mistakes, perhaps more from your mistakes if you're honest about them than from your supposed successes and triumphs.
The next question is actually about a recent theme in markets. Proposals coming from policymakers to restrict stock buybacks. What do you think the impact would be? Does it affect corporate finance? Does it affect wage growth? How do you view the effort to restrict stock buybacks?
Look, it's a political statement that was made by two Democratic senators, but it's been a view expressed for a long time by those who are critical of companies with a lot of cash flow, high growth companies in particular, sometimes a lot of them in the technology space, who don't have the vision, the guts to invest them back into their businesses and build more lasting, innovative platforms for the future. So there's an economic piece to it, but this joint editorial by Schumer and Bernie have turned this into a political debate, I think, that is actually quite unfortunate.
Anybody else?
I'll take a different tack, more economics standpoint based on a variety of research. The first issue is, to the extent that buybacks are supportive of earnings per share, it does have implications for enhancing wealth inequality, because the holding of stocks in the wealth portfolio is so concentrated. So, if you care about that, that's a legitimate issue. The second one, you didn't ask about M&A, which is another kind of version. So, but I'm going to take that up because, if you have a lot of mergers and acquisition, you reduce competition in the marketplace. Think about Dow and DuPont. They are now a single company. They no longer have to compete with each other for innovation. They also don't compete with each other for workers. And so, again, using firm-level data, there's quite a bit of evidence that concentration has been associated with wage compression. Usually when we think about competition policy, we think, oh, well, we don't want monopolies because they'll raise their prices using monopoly power. But the data are more supportive of the phenomenon that monopoly power has been expressed in the form of wage compression and maintaining earnings for companies through that channel, as opposed to through the channel of increased prices. And the last point I would put on this is, I'm not sure you need regulation to handle these issues. We have competition policy, we could work on that. We have a variety of taxes that we could deploy. But the third dimension of this is that, to the extent that firms lever up and borrow in order to deploy, so it's not a cash flow situation, they're actually levering up, they're borrowing to either engage in M&A or to engage in buybacks, rising policy rate makes that more expensive. And that acts as a natural balance to whether or not it makes sense to do those kinds of financial engineering.
Yeah, I mean, a lot's already been said. The only thing I would add is that buybacks and dividend payments are economically fairly close to one another. So I think if you did make buybacks more unattractive, I suspect that a lot of the cash that's being returned to shareholders would show up through dividends. At the moment, there is a choice to use buybacks for a variety of reasons, including tax considerations, but dividends fulfill a similar economic function.
Great. There's a lot of interest in whether there is information in the shape of the yield curve today and whether it's being distorted by special factors such as the size of the Fed's balance sheet. What do we learn from the U.S. yield curve and from yield curves elsewhere about the outlook?
I mean, for 2s, 10s, I would say, if you look at the longer end of the market, 10-year yields versus 2-year yields, I do think it's being distorted by just a very low term premium, which partly reflects large central bank balance sheets, but a variety of other factors. I do think that when the term premium is very low, then it's much easier to invert the yield curve because the average slope is no longer 100 basis points or 150 basis points as it was perhaps 20 years ago, but the average slope is equal to the average term premium, and if that's in the 20 basis point, 0, maybe even negative range, it doesn't take that much in terms of expectations for the path of short-term interest rates to invert the yield curve. So I have a preference for, in evaluating what markets are saying about the risk of a policy reversal that may be driven by a recession, to really look at the shorter end of the yield curve, consistent with work that's been done and published by staffers at the Federal Reserve Board, and so I would probably focus more on what the Fed funds futures or various swaps contracts say about expectations for the funds rate. And at the moment, as I said earlier, there is an expectation of some cuts priced in, so that does, I think, reflect an elevated level of concern among some market participants that we're going to go into recession soon. And we did at Goldman Sachs, we did a number of conferences with clients around the world in several cities in Europe, several cities in Asia over the past several weeks, and there is a consensus view that the U.S. is going to go into recession either in 2019 or in 2020, and I think that's consistent with what you see there. The question then is, of course, whether you agree with that, and as an investor, or as a forecaster, you're to some degree in the business of disagreeing with general expectations. So as an investor or a forecaster, you have a somewhat different perspective on this relative to a policymaker. A policymaker would say this is a sign of elevated risk. As an investor, you might say this is an opportunity, because if I basically take the other side of this view, that can produce superior returns, if I'm right.
So I agree as well that the 2/10s is not a good representation of the probability of a recession. And again, I also see that the 10-year yield plays a very important role in many types of financial engineering aspects. It's the collateral, it's the thing that you're going to use for taking bets on the shape of the curve, and so it ends up having some financial engineering demand for it, which is independent of sort of the economic fundamentals that would normally be in place there. And many people sort of look at the 10-year now and sort of say, well, it's probably 30 to 60 basis points, the yield is 30 to 60 basis points below where it quote should be. Now, if you're in the financial markets, you'd say, well, it should be where it is because that is the equilibrium between demand and supply. But so there's a tension between the financial markets should be and is, because that's the equilibrium, and what other people think of as drivers, economists, drivers of the 10-year yield. So because that is one end of the 210, and it's lower than it, yield is lower than it quote, quote, should be, then that creates the impression of a higher probability of recession risk than you would get from analyzing economic fundamentals. That's partly why in my opening remarks, I emphasize the degree of domestic resilience in the US economy, but also in other economies, because it's not impossible to go from where we are now into a recession in 2019. You could create scenarios where the trade headwinds are so strong and the financial turbulence is so great as to undermine the business investment as well as consumer attitudes. And so, yes, you can engineer a recession. You have to work hard to do it, but you can do it. And the self-fulfilling prophecy is a concern. It's definitely a concern. And the more emphasis there is on, well, there's definitely going to be a recession, then you wonder about it being a self-fulfilling prophecy. I do think that there is a challenge that we see between the kind of the quote-unquote real side and the financial side. They are not telling the same story at all about where we are in the US economy, but also in the global economy. And I think you see that playing out in other ways as well. For example, the Duke CFO survey that you perhaps have read about, they're sort of saying, oh, well, the CFOs are saying that there's a high probability of a recession in 2019. Well, there was two questions there. The first concern of the Duke CFO survey participants was they couldn't hire enough workers to satisfy the demand for their product. The second concern was, well, there's going to be a recession in 2019. That's a little schizophrenic, but it does outline this tension between the real side and the financial side, and that's why we need to kind of follow these two different sides really carefully, these two trajectories, because they're not merged yet.
Steve, pass?
No, I'll pass on that one.
Okay. Well, the next one I think is going to be closer to your bailiwick. We've talked a good bit about near-term performance. Most of you have suggested China's in the process of slowing near-term and has been for a while. What about the long-term prospects? How do you see China's long-term growth prospects? And in particular, have they changed recently, say, as during the period of the leadership of Xi Jinping?
Well, look, I have been pretty steadfast in my optimism for China for a long time. And the story for me has been a rebalancing story, moving away from the reliance on external demand and investment to more of a services and consumer-based framework, and relying on the development of the services sector to generate jobs and rural-urban migration to boost real wages. There's still a problem with too much precautionary saving because of the lack of a well-developed social safety net that the government is trying to address. The economy has slowed a lot in the last several months, and this has caused, I think, a lot of nervous Nellies to say that, the end is finally at hand. We've been talking about the crash of China for decades, and now they're all convinced this is finally the case. Keep in mind that the major downward impetus that's playing out in China right now has been self-imposed. This has been mentioned earlier, I think, both by Jan and Kathy, through the deliberate effort at deleveraging to avoid a Japanese-like debt overhang. Yes, the trade headwinds have started to exacerbate this, but I think this is a correction that is necessary and important for China to stay with. a friend of mine, and you know him well as well, Nick Lardy, you know him, Kim, has written a new book about his personal disappointment with the lack of state-owned enterprise reform in China as being a new wrinkle in the long-term prospects for China. I would agree with that, but I think that China is well positioned to withstand that as well. I continue to believe that, and this is a little bit different than Nick Lardy, that China is now making extraordinary progress in shifting away from imported to indigenous innovation, and this is a critical driver of the next phase of the Chinese economy. We may not like a lot of the things that are going on in China. There's a number of issues, both domestic, political, social, and a party-centric view of Xi Jinping that may make us uncomfortable. But I think the core story of a balanced, innovation-driven Chinese economy remains very much intact and keeps me quite confident about the long-term prospects for the Chinese economy.
Differences?
I'm not quite as optimistic as you are. But the two factors that I think we need to keep our eye on is how well do the policies that they've put into place serve to enhance the rebalancing, which I agree 100% is a key ingredient. We know that a number of the consumption-based or household-based strategies are designed specifically to be supportive of the domestic industry as opposed to imports. But we also know that there's still some investment going on that probably doesn't have a great rate of return. And then how much of the financial deleveraging is going to be unwound because of the desire to maintain a growth rate sufficient to be supportive of employment. So I think that there's a bit of a backsliding that means that it means it's more difficult to get to the long run that you've outlined. The point that I think from a global international economist standpoint, the key factor for me is China going to be ultimately a net exporter, or like a Germany, Japan type of economy, or are they ultimately going to be more like the US, kind of closed, basically a net importer? Because from a global perspective, those two are very, very different stories for the global economy.
Great. Anything else?
I'm going to pass.
Okay. I think we're getting close to the end, so I hope you will join me in thanking our panelists for an excellent discussion. Just wait one moment. We'll be posting video of the proceedings probably in the next week or two. I'm also hoping you'll bring up it's already there. We hope to see you again at two events that are coming up over the next month. On September 20th, former U.S. trade representatives Carla Hills and Mike Froman will come to discuss U.S. trade policy. And then on March 6th, 1 month from today, former U.S. Treasury Secretary Robert Rubin will do a fireside chat. We hope you'll join us. Thank you very much for coming today.